Hi everyone! This video will be about fast-moving consumer goods financial model of a business plan. We are business planners and we can help you to create your business plan or financial model in Excel. Subscribe for more videos. Please like and share to help the channel grow. If you have a business idea of starting your own business with FMCG, this very simple financial model can help you to evaluate the amount of money you need to start this business. Besides, you will also be able to see the profit, payback period of your investment and profitability of your future operating activity. Of course, it will be very interesting for you to know how stable your business idea is if something happens with revenue and expenses. So now let's go through the model and I will show you what items you should pay attention to if you want to run this business. In this model, all inputs are colored in blue. Other sales are automatic. First of all, you enter the year when your financial projections start. You start with naming your markets. These can be different countries you are going to operate in. Then, you specify the month and year when you start selling your products on each market. You can also switch on and switch off every market to see the financial efficiency with or without this market. This item is useful for future scenario analysis. Now, let's move to one market and look at input data more closely. First of all, you name all products for this market. Of course, you can switch on and switch off any product from this market. This will help you later during scenario analysis. Then you have to specify sales plan for each product for the first 12 months of operating activity. These 12 months are special because they are the first. Separately specifying the first 12-month sales plan, we can look afterwards at cash flow statement to see if there are operational losses before your business idea reaches break-even point. Looking at cash flow statement, you will be able to see what are the first months with operational losses and also be able to see the scale of these losses and the duration of a period of these operational losses. This is very important for business owner at the first months of operating a business. It is so because you need to know how much extra money you must be ready to invest in financing of operational losses. All this is vital because all this time, while operational losses do exist, the entrepreneur is patiently waiting until the investment project becomes finally profitable. Then we look at the next 12 months of operating activity. These are 13th months to 24th months of operating activity. And here we make a typical year sales plan seasonality. Your sales may be stable inside a typical year, but also you may have some seasonal fluctuations in sales which are to be mentioned here. We have a simple rule. The total sales plan is 100%. Here, we must allocate 100% of sales among 12 months of typical year. If you allocate more or less than 100% of sales, you will be shown a mistake sign. sales plan with specified seasonality will be extrapolated on all other years of your financial projections except the first 12 months of operating activity. Then you move to sales growth percentage to the previous year. Then we move to direct costs. In the first column, you name all your direct cost items which take part in your business. Then you set up a price per 1 unit of each item of direct cost. Your direct cost item may have some terms of supply. Here you can specify these terms. 0 means that you can get this material months and months without any term of supply. 1 means that if you need this item today, you need to buy it 1 month beforehand. Here, you can specify up to 6 months supply period. The next column describes how often you buy each direct cost item. 1 means you buy it every month. 4 means you buy it once in 4 months. 12 means you buy it once a year. Here, you can enter amount from 1 to 12. Then you go to the next block of input data concerning natural consumption of direct cost item per 1 product. Here, from top to the bottom, you have a list of all direct cost items. From the left to the right, you have a list of your products. In the input area, you enter natural consumption of each direct cost item in metric you buy it needed to produce 1 product. Now we move to the pricing strategy. Let's describe this block of inputs. You have 4 types of customers for each product. Then you distribute produced amount of each product among 4 types of customers. If distribution is higher or lower than 100%, you will see the mistake alert. Then you set the price for each product for each customer type. Now you have to describe how your customers are going to pay. Here you have months from 1 to 4. 1 is the current month when the product is sold. Here you go to the future months from today's moment. If you sell it in this month and get all the money in this month, you put 100% here. If you sell it in this month but get all the money in the next month, you put 0 here and 100% here. Here you can assign any payment algorithm. If you set up more or less than 100%, you will get a mistake alert. Then we have a payroll table where we mention salaries, positions, and the amount of people on each position. Our current market may also have some fixed costs which can be specified here. The next block of inputs deals with investment needed before you start operating activity stage. Green column will show you the moment when you get the first revenue. Moving to the past from the moment of revenue, you describe the investment stage. Here, you specify what item you are going to invest in, when you invest, and how much you invest. Going ahead, you also have a depreciation table. If you have a depreciation for the investment item, you can set the depreciation status and specify the period of depreciation in months. The same story with inputs happens with all other markets. The next block of inputs deals with taxes. You can set the tax rates and move to the cash flow statement, where you will see the results of financial modeling. Cash flow is the main statement where you see financial efficiency of your business idea. What valuable information can you get from this table? First, you can see the total revenue, direct and fixed costs, payroll, and taxes. Second, you can see your monthly profit and cumulative cash balance. Third, one of the main things you'll see from cash flow is total amount of money you need to start the business. If you see that total financing is bigger than amount of money you have, you can add loan parameters. Amount of loan, month and year you get it, loan term in months, interest rate, and grace period for interest and body payment of the loan. After cash flow statement, you can see lines with profit and profitability. Then you can set a discount rate and look at the final financial efficiency parameters of your business idea. Now you can see the graphic illustration of your business idea. Here, you see in monthly detail simple and discounted payback period, loan coverage ratio, revenue and total expenses, profit, profitability, cash balance, cumulative profit, operation profit, and loan payment. Then you have the same information done yearly. On the next Excel sheet, we have gathered yearly consolidated cash flow statement, profit-loss statement, and main financial results of your business idea. Finally, you see the financial efficiency of your FMCG business idea. Is this model stable? What will happen to your business if revenue decreases or expenses rise? Now it's time to apply sensitivity analysis. Further, we have several Excel sheets where we test financial efficiency. We test the influence of such parameters as revenue, fixed and direct costs, payroll, investment, interest rate, and loan amount. How does it work? For example, let's go to the revenue sensitivity test. Here, we set the pace of increasing or decreasing the revenue. Then, we push Sense button and see when the financial efficiency will go negative. Now you see how stable this business model is. Now it's a great moment to rethink your business strategy in time before you start investing your money in business. Maybe it's a good time to return back to inputs and create new scenario which is more financially strong. The same story goes with all other blocks of sensitivity analysis. So this was FMCG financial business model, which can help you to check quickly the vision of your future business idea. The link to download is below this video. If this video was useful to you, please like, share and subscribe. Should you choose to take action in your startup, we can help you with business planning and financial modeling. Let's test your business idea. Stay tuned and bye-bye!